Hello, this is Books of the Stock Market. How's everyone doing? As for me, it is officially too cold to run at 6 in the morning. It was 44 degrees outside, pitch black, and when I went outside, I was like, nope, going back inside. Anyways, the book finally introduces actual material and I'm eager to talk about it. Since there is a strategy that is actually being introduced, at the end of the video, I'll be providing examples where I will be applying what I've covered in the video into today's stock market, which is the day of recording, so October 1st. So stick around till the end of the video so that you can watch me apply what I've covered, as applying and just knowing are totally different things. This video will be talking about the Dow Theory, which is considered by many to be the first technical analysis strategy ever made. First, let's start off with a history lesson. So the Dow Index was created by Charles Dow and Edward Jones. Charles Dow is the person on the left and Edward Jones is the person on the right. When the index first came out in the late 1800s, it was made up of 9 railroad companies and 2 manufacturing firms. He eventually separated the index into 2 indices so that he can represent the overall health of the economy more accurately. One of the indices was called the Dow Jones Transportation Average, and it contained 20 stocks. The other index was called the Dow Jones Industrial Average, and it contained 12 stocks. This average eventually became 30 stocks, and this is the one that is still talked about in the news. Unfortunately, he never wrote a book, but he did write several editorials for the Wall Street Journal. After his death, people collected his writings and wrote a book where it teaches the Dow Theory. At this point, you're probably saying, enough with the history lesson, give me the strats. Okay, then you're in luck, because the remaining portions of this video will be describing the Dow Theory. The Dow Theory is made up of 6 basic tenets. They're shown here. The first one, price of 2 averages discounts everything. The second one, unless trends show signs of reversal, the trend will continue. The third one, the 2 averages must correlate with one another. The fourth one, market has 3 types of trends. And the fifth one, 3 phases make up major trends, and the major trend is also known as the primary trend. And the final one, that trend needs to be confirmed by volume. Now, onto the first tenet. If you watched my last video, then you know exactly what this means. The price of 2 averages discounts everything. If not, I'll link the video in the description section below and at the end of the video. But for now, I'll just give you a brief explanation. Basically, Dow was saying that everything is already priced in. This means that you should ignore all news surrounding the average, or anything else that even relates to the average, because everything is already priced in into the stock's current price. Today, we apply this tenet to individual stocks, and it works out pretty successfully, even though he thought about this more than 200 years ago. Like the first tenet, the second tenet was also covered in a previous video. So yeah, watch it when you have time, as it covers these topics in a deeper fashion. But for now, the second tenet basically states that it is probably more likely that a trend holds and continues, and it is only reversed when there are certain signals that are produced. Today, there are numerous tools and indicators that help spot these reversals, and they will be covered in later videos. However, with these tools and indicators, it is still pretty hard to spot a reversal and time it perfectly. So I'll bring up examples a little later on in the video to show how hard it is to time it perfectly. Let's move on to the third tenet. The third tenet states that the 2 averages must correlate with one another. So what does this mean? At the time, Dow meant that his industrial and transportation averages needed to be both rising or falling in order to confirm a bull or bear market. If the averages gave different signals, then they'll cancel out and the prior trend will still be maintained. So let's look at an example to help understand what I just said. The graph below shows the Dow industrial and transportation averages. As you see, we can confidently state that we're in a bull market if we used his standards. Why? Because both the industrial and transportation averages are in an uptrend, and they confirm one another. Today, we can apply the third tenet to the major indices of today, so the S&P 500, the Nasdaq, and the Dow. I'll be doing this in the application section of the video, so continue watching as applying is really important in the learning process. The fourth tenet states that the market has three types of trends. The first type of trend is called the primary trend, which is also known as the major trend. These trends last for years and they define whether the stock is in a bull or bear market. The second type of trend is called the secondary trend. The secondary trend happens within a major trend, and they represent the pullbacks in a bull market and rallies in a bear market. These trends usually are months long. The third type of trend is called a minor trend. The minor trend happens within a secondary trend, and Dow thinks that they're just noise as they only last for weeks and make no difference in the overall major trend. However, toward the end of this video, we will learn how this can be applied to trading futures. The three types of trend make up the general uptrend and downtrend. Dow defines an uptrend as when the stock makes a higher high and a higher low. He defines a downtrend as when the stock makes a lower high and a lower low. Let's move on to the fifth tenet. So the fifth tenet states that major trends are made up of three phases. The first phase is called the accumulation phase, and this is when the smartest investors discover that a stock is done moving downward, as the majority of bad news has been priced in. The second phase is called the public participation phase, and this is when technical analysts start to buy as their signals and indicators are triggered after the smartest investors push the stock upwards. The final phase is called the distribution phase, and this is when mainstream media promotes the stock by publishing overly bullish articles causing people to come in and buy. From here, the cycle starts over and the price drops from the top and we enter the accumulation phase again. If this sounds a bit familiar, this is because the Elliott wave theory is based on this. For those who do not know what it is, don't worry, there will be a future video on this topic. But for now, isn't it incredible that Dow was able to formulate all of this 200 years ago and his theories are still relevant today? I think that's actually amazing. Finally, let's move on to our last tenet. Our last tenet is very straightforward, but is still very important. Basically, the volume must confirm the trend. This means in an uptrend, volume increases as price rises, while volume decreases as price falls. In a downtrend, volume increases as price falls, while volume decreases as price rises. Today, there are many indicators that help show this. For instance, indicators like RSI or MFI help track this, which once again shows how relevant Dow's work still is after 200 years. As with all strategies, there are critics that bring up relevant statements. The first criticism is that the Dow theory usually misses up to 20 to 25% of the movement before a signal is produced. So why does this happen? This happens because in an uptrend, Dow states that you have to wait for a higher high and a lower high to form, while in a downtrend, you need to wait for a lower high and a lower low to form. Waiting for these two steps usually means that when the stock makes a higher high or a lower high, you have to wait for its respective lower high and lower low. This waiting contributes to the 20 to 25% of the missed opportunity. However, it is important to note that Dow made his theory to recognize major bull and bear markets, and he wanted to see how the overall economy was doing, not to trade in intervals of months and weeks, and of course not days. Now we move on to the application section of the video, which is arguably the most important section in this video. In this slide, we will see how hard it is to time an exit and the ambiguity that comes with all trading strategies. Okay, first let's look at the graph on the left, which is also known as a failure swing. Using the Dow theory, we need to see if the stock makes a higher high and a higher low before buying the stock. Basically, you see that at point C, the stock makes a lower high as it is lower than point A, which was the stock's previous high. This means that the stock was not able to make a higher high even after making a higher low at point B. This causes the stock to sell off since it does not adhere to the Dow theory. At this point, investors needed to put their stop loss at level E, which may have acted as an area of support, but in this case it didn't and the stock plummeted. This was a pretty clear-cut example where when using the Dow theory, it allows you to protect yourself from a loss. Let's move on to the second graph. The second graph is called a non-failure swing, and this is where everything gets ambiguous. At point H, the stock makes a higher high as it is higher than point F. However, it eventually falls below level L, which was the support level based on point G. At this point, some people who use the Dow theory would sell because it failed to make a higher low. However, other people who use the Dow theory would need to see a lower high before selling. Point J provides a lower high after getting rejected by level L, causing the stock to drop to point K. As seen, there is always ambiguity in all trading strategies, and it is important to remember to not rely on only the Dow theory and use other signals and indicators to help you predict future price action, which will be introduced in later videos, so remember to subscribe so you can become a more educated trader. Okay, let's look at this graph for a more practical example. Here you see a chart with the S&P 500, the Nasdaq, and the Dow. In the green circle, which represents the early portions of September, what do we see? We saw the yellow line, which represents the Nasdaq, get away from the S&P 500 and the Dow. At this point, traders should have been careful as the separation upward was not supported by the S&P 500 and the Dow. More importantly, however, the Dow did not make all new highs at this point. With both the Nasdaq separating from the S&P 500 and the Dow, along with the Dow not making new all-time highs, this should have warned traders to get out of their positions or add to their short position. This is because the Dow theory states that averages, in this case the S&P 500, the Nasdaq, and the Dow, must correlate with one another as stated in Tenet 3. Since this did not happen, it caused a rapid fall to a point where the S&P 500, the Nasdaq, and the Dow were at similar levels again. The funny thing is if you look at the purple circle, what do we see? We see the Nasdaq is running away from the other two indices. What does this tell us? If we use only the Dow theory and nothing else, we will see the Nasdaq coming back down again sometime in the future. By the time this video is uploaded, you guys who are watching the video will be able to see how the market unfolded. Did it follow the Dow theory or did it not? You can answer the question in the comment sections below, and I will respond if needed. Okay, let's move on to some other applications. So Dow wanted his ideas to be applied to major trends that lasted for years with the aid of intermediate trends that lasted for months. Futures, on the other hand, was made years later, but remarkably, his theory still holds. Instead of trading based on major and intermediate trends, future traders would trade on intermediate trends while using minor trends as signals. Basically, by the nature of the shorter-term perspective of futures, trends that represent shorter time lengths were used instead of years and months. Well, that's it for this lengthy video. I hope you guys learned as much as I did reading the book, as that is the whole point of the channel. So far, the book introduced the Dow theory, which is a fundamental strategy in technical analysis. I'm eager to tell you guys the numerous other strategies in this book, so remember to subscribe so you don't miss out on any of them. Also, please like and comment on the video if you learned something new, as it really supports the channel. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.